Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and also Portfolio Manager. Thank you, as always, for joining us on this week's edition of the Market Carver. We've got three topics for you this week. We're going to talk about a rise and some delinquency rates, and we'll cover what that means or what it could mean for the economy. We'll talk something we hit every once in a while about just how hard in this business, the investment management business, it is to stay on top. So I have some numbers along those regards. And Andrew will share an update, a look at market internals. But let's start off with debt delinquencies and what we see in terms of a rise. So we have several different versions of credit. You have your auto and credit card, mortgage, student loan. But all except for student loan, we have seen them continuing to rise. And this is where rising interest rates meets rising costs and basically every bit of our cost of living increases and such. Those two forces have combined and made it very difficult for consumers to keep up with a lot of their consumer credit. I'd say the one thing that stands out is, of course, the student loan. We had a moratorium for a while, and why this is interesting in particular is it's expected for the Supreme Court to rule on the plan to forgive a lot of student loan debt. So we should see that move the needle one way or the other. Of course, if the Supreme Court comes out and nullifies that deal, there could be some ongoing pressures in the student loan sector. Of course, one major key to this in terms of keeping a lid on it, not letting this trend continue, is the job market. The job market has continued to be resilient. So it would certainly be a cause for concern if the job market were to roll over, because we already kind of have bad trends in these categories. So again, most of the economic releases have been decent. But if we look for tea leaves and things that are kind of at the leading edge of where things are deteriorating in the economy, we do continue to see it in a pinched consumer. Moving on next to the investment management industry. And this really stuck out. I saw this study. And what we're going to look at on this table is first, we're going to look at the start December of 2018. And this is the number of funds. The top piece of this are the number of funds that are in the top quartile of their category. So you've got all domestic funds and then different varieties of domestic funds, your large cap, mid cap, and so on. And you can see how many different funds in December of 2018 were in the top quartile. And then you see them progress. How many of those, 527, or what percentage of those by December of 2019 were still in the top quartile? 1 year later, that had dropped to half. But this is what's remarkable. In every single one of those categories, large, mid, small, multi, all of them, by December of 2022, not a single fund that was at the top quartile in 2018 remained. So that's why for us, it's very much an important piece to focus on process and that we have something that can sustain through time. It's not always going to be at the top of the charts. Of course, that's always the goal, but that's why our focus is on process, because it's so difficult to sustain active selection. The bottom part of this is how many were in the top half. You could see a similar, there were a few stragglers or a few funds that were able to stay in the top half over that time frame. But if you're looking at purely the top of the top, it just doesn't happen. So that's active fund management. Andrew, we'll turn it over to you to talk about market internals.
Thank you. So last week, Joe did a great job stepping in, and he was talking about the identification. Are we in a bull market, a bear market, bull market? Where are we? It was in the headlines a lot as the market had risen 20%. And a lot of people were trying to identify we're now in a new bull market. What's the difference between we're up 19.5% to 20? There was nothing magical about that last 0.5%. What we really focus on in our analysis is looking at market environments, not trying to put labels on them. And so we look for things that are happening within the market that are very strong characteristics of strong uptrends or strong characteristics of downtrends. And so a really interesting study done by a top tier firm called Ned Davis Research came out and found that we would see repeated new highs being made for a majority of stocks in uptrends. That's nothing groundbreaking. More stocks going up, it should mean the market's going higher. And so what I'm showing here on this week's chart is going back to the mid 1990s, and when we have the net number of stocks, meaning when we take all the stocks making new 52-week highs, subtract the ones that are making 52-week lows, and we have that net number breaking above 10%. I mean, we have a lot more stocks making new highs than lows, and that's a characteristic of a rising market. And I plotted a green dot every time this happened. And then the opposite happens, more stocks making 52-week lows, we get a red dot. And that's a characteristic of a downtrending market. Thankfully, we have a lot more green dots on this chart than we do red, because traditionally the market is spending a lot longer time going up. And so now we want to fast forward to today's market. Where do we sit today? And so I put kind of a zoomed in version, because it's such a long-term chart, on the far right side, and we can see today's market. We saw last year we had several red dots. We had more stocks making those 1-year lows than making new 1-year highs. And so we're starting to see that trend reverse. As of last week, we're at 8%, getting really, really close to that 10% threshold that's been such a strong characteristic of an up moving market. And so to say this is one of the few points that we haven't seen yet that's really kind of helped confirm this new uptrend. But we're getting really close as stocks really are starting to expand and grow, and we're seeing a lot of these trends start to move higher. Now, this doesn't necessarily mean we have to get hit 10%. We're going to continue to rocket higher. We do see pullbacks. That's very normal in this market, and we are kind of a little bit stretched in the short term for equities right now. So a slight pullback would be normal, but we are seeing an expansion of breadth, something we didn't have a lot of at the start of the year. So we're very encouraged that we're starting to see that now, and we're at 8%, getting close to that 10%. And this is a good sign, a good characteristic of an uptrending market. We'll be watching this in the weeks ahead to see if we do continue to see that expansion and we get to that 10% threshold.
Very good. Yeah, as you, most of you probably know by now, a lot of you watch this week in, week out. It's been something we've been harping on and really hoping to turn around. It's a much better, healthier market if we can just get more stocks chugging along. So
Right.
thank you, Andrew, for breathing a little bit of breath of fresh air for us for the market. So, hey, listen, thank you all for giving us a few minutes of your time. As always, don't forget to schedule your next step meeting if there's a way that we may be of service. 800-928-4001 or scan the QR code. Thanks again and have a great weekend.